Well, now let us explore the spreads. We already seen how covered call and protective puts will work and how to set the diagrams and the pivot tables. And we have also seen how a protective put can be used for a portfolio insurance concept for an index value. Okay, now we go into spreads. Mainly what I told you spread is that you spread out the strike prices. Spreads are strategies in which options of a given type can be all calls or all puts are combined into a portfolio. Maybe two call into one portfolio or two puts into one portfolio, depending whether your direction is bullish or bearish. Vertical spreads. When we look at the vertical spreads is where it's same maturity but different strikes. You go for one call option, you sell a call option at a lower strike on the same maturity, and you sell a call option, you long a call option at the lower level, and you sell a call option at a higher strike with the same maturity. You're protecting yourself between the margins of the two different strikes. So this is why we can create bull spread or bear spread. And of course, when you have got more than three different strikes, then it can mean to have a butterfly spread also. Okay, the horizontal or calendar spreads. Remember, horizontal spreads or calendar spreads are same strike but different maturities. There you are. So we are not going to concentrate too much on horizontal or calendar spreads, but we're going to concentrate more on the vertical. Let us first look at the three vertical spreads. That is a bull spread, where you long a call at the lower strike and short a call at the higher strike. Bear spread is you long a put at a higher strike and you short a put at a lower strike. And of course, the butterfly spread, which has got multi strike prices. Let us see one by one. Bull spread. The motivation is that you are bullish on the stock price movement. You know the stock price is going to go up. There may be a swing, but of course the volatility is not large. Direction is bullish. Volatility is not large. Two possible strategies can be combined. That is, what you can do is you can buy at the money call option and sell at the money put option. But what will happen if you do this? Let's say you buy at the money call option and you sell at the money put option. Different strikes. Cost and risks of these strategies are actually useless strategy, this one. First strategy is upfront cost is high because the calls may be very expensive during the bullish direction. And when you write the put option, it won't be much of a premium for you because the direction is bullish. Nobody's going to buy put option. If they're going to buy also, they're going to buy at a very cheap margin of a premium. Second strategy, large losses possible on return put as the stock price is bullish direction. Why large losses possible on the return put is that you have written a put, you have a small premium. The swing is supposed to be bullish. But of course, if the direction goes bullish, you're going to make money in the call option, which you long, with a very high premium. To subsidize the premium, you have written a short put. If the price don't go up, if the price goes up, of course that put won't be exercised. Your premium is very low compared to your premium what you paid for the call option. Okay, therefore we don't use that strategy. We go for a bull spread strategy. How a bull spread strategy works. Long a call with a lower strike at K1 is going to be close to at the money. If a slight increase, you are ready to exercise at a lower strike. But you know the price may go up. in a short term in the bullish direction, but may not reach to a certain point where it is K2. So you write another call at K2, higher strike. Why you want to write a K2 strike is because the call option is because you want to subsidize the premium of the long call at a lower strike. At the bullish season, when you long a call at a lower strike, you're going to pay a bomb in premium. It's going to be very expensive. But at least to subsidize that, you don't have to have a very big profit to reach to break even. So you write a shorter call with a higher strike where thinking that the price may not reach up to that, and the call which you wrote may not be exercised. So K2 is higher than K1, both having the same maturity. The resulting combination of the portfolio is called bull spread combination. You look at this diagram. Yeah, bull spread using calls diagram. See, you've got a K here, K1. You bought a long call at K1 where if the ST goes just a little bit above K1, you will start exercising. This is the incremental time until K2. But you have sold a call at K2 with the idea that the price may be somewhere here now below K1, may swing up to above K1, but may not reach above K2. That is the idea. So, if the ST is below, you see three things can happen here. Either the ST can be below K1, or the ST can be above K1 but below K2 is the most beautiful good area, or the ST can be above K2. So we will see how the functions of this will happen. The stock price range, if its ST is below K1, if you look at the diagram again, when the ST is below K1, nothing is exercised. Your long call is not exercised. Your short call is also not exercised because the ST is below here. No point of exercising anything. But so therefore, payoff from the long call is 0. Payoff from the short call option which you sold also 0. So the total payoff or the profit function is 0. But here, when the ST is above K1 but below K2, see when the ST is above K1 but below K2, this is where the incremental value comes in. As the ST moves up and up and up and up, you will exercise the K1. The long call at the K1 will be exercised. The higher the ST you are getting, better for you. But the limit is at K2. But the minute it breaches K2, you still make profit in the long call, but you will be losing it out in the short call, which is sold at K2 as the second the second exercise or the strike price. So what happens in the rate profile line here, the profit is that when the ST is below K1, you are well and good because the premium would have been a very large one, but it was subsidized by the short call premium here, and the profit line is, the loss line is lower. Your premium has been subsidized. But you look here in the diagram, the payoff from the long call is ST minus K1. Because the minute the ST is breaching the K1, you can exercise. So there's a payoff ST minus K. But below K2, the short call won't be exercised, so it's 0. So your total payoff is ST minus K1. Okay, you will get profit there. But looking here, if the ST is above K2, most happening place. Why? Because your long call, the first long call at K1 will be exercised. At the same time, the short call at K2 also will be exercised. Wonderful. When ST is above K2, see, your payoff from the long call is ST minus K1. Your payoff from the short call is K2 minus ST. So if you calculate this algebraically, ST, positive ST and negative ST goes off. What is left now is K2 minus K1. So the profit function here or the payoff function finally ends up at K2 minus K1. Don't you understand? Here, of course, your profit line is incremental when the ST was between K1 and K2. But after that, don't worry about the loss in the short call because you're taking the profit from the long call here and you are financing your short call. So the profit is neutralized there. That is why when you see here, low, up there to K2, and then this is a horn. That's why it's a bull. So your loss is protected there, right? Your profit is limited there. But of course, between the K1 and K2, you're happy that your profit is incremental, while the short call is not exercised yet. That's why I say the original idea is that the ST could be below K1 now. You know there'll be a bullish direction with a volatility that it may not jump to reach up to K2. So you can profit from that, right? You understand? That is the bull spread. So bull spread with calls, when you feel the stock price will jump to an increase above K1, but will not reach to K2, a bull spread using calls is a strategy where you are long a call option at the K1, where the cost will be very high, the premium will be high, then short a call at the K2, where K2 is higher than K1. This subsidizes the high cost of the first long call. At the inception, K1 strike is chosen to be at or near money. Maybe right now the stock price is $20, and the first call which you are buying may be $22, just $2 above it, or even at $20 itself. That's why the premium will be very high. This makes the strategy very bullish because the minute the price moves up a little bit, you're going to exercise. Selling the second call at the K2 reduces the upfront cost of this strategy, where you are selling it for getting some premium which you know very well may not be exercised. Even if it's exercised, the loss is limited there because you can take that part of the profit from the long call to pay off the short call. It also caps the benefit or any benefit from the price increase above K2 is now lost to K1, right? Okay, numerical example. Let us have a look at the numerical example to make your bull spread very, very easy to understand. This example uses the following information. A hypothetical stock is trading at S0 is 100, assuming that S0 is 100 now. 1 month call or put options are available. The stocks were is available at a 95 strike, $100 strike, and 105 strike. The options have the following prices. When the strike price is 95, call option is very expensive because now it's 100, but you are buying something below, lower than at the money. So it is $6.95. But if you buy at the money, $100 also, it is $3.09. But if you buy above the current stock price, it is $1.21. But you look at the put price. If you're buying at below that, 95, the put price is the lowest. If you're buying at the money, it is $2.67. But if you buy above that, that means you are going nearer to exercise a put option. If it falls a little bit also, you will exercise. That means which means that it is below at the money level now, it's $5.77. But since our example is a call, see, we both are a call involved here, so we will look at these prices in the call itself. Let us see. Suppose you are bullish on this stock and you're considering buying at the money that is K equals to 100. The key concern is upfront cost of the call is $3.09, 3.09. Price has to increase at least to 3.09 for the trade to be profitable because your K is 100 and you are paying $3.09. So if the ST goes up to $103 and 9 cents, it'll reach the break even. So if you want to bring down the break even to a nearer, then you have to subsidize the 39. So possible alternative to set up a spread, that is buy $100 strike call for $3.09 and sell 105 strike for $1.21. So consequence is upfront cost is reduced. $3.09 minus 1.21, your cost is only 188 now. So now the stock price need not go very much higher up to $3.09. It can just reach 1.88 also you can break even already. Upside benefit is capped at the 105 because once it reaches 105 and above, of course your short call will start to exercise, but you can use your long call money to pay off the short call. Beyond that, anything gained from the $100 strike long call is lost on the 105 strike short call. If you think the price increase above 105 is unlikely, and this is a good trade for you. Well, we have just seen how the bull spread helps you to save money. At least in the upside potential is good and the downside loss is not much. Okay, we have seen a numerical example. Okay, bull call spread, another example. Let us have a look. XYZ stock is trading at $70. Call strategy, buy September 2020 $70 strike at call of $13. Okay, bull call spread, buys September 2020 at $70 strike, that at $13 price, and sell a September 2020 $100 strike for $5. That means you are buying a call for $13 September 2020 at a $70 strike, and you are selling a call for $100 strike, exactly the bull you bought at K170, you're selling at K200, but you are selling it for $5. So how will it work? Capital invested, of course, to buy the long call is $13. The bull call becomes $8. Why? Because, okay, if you're just buying the long call alone, then it is $13. And you bought it at a strike of $70, right? So the profit level is when the price ST goes up to $83, that it has to go up to $13 to recover back the premium. Then at 83 it is break even. So maximum profit is unlimited, of course. You're going to get very high profit if the ST goes above $83. But if you have a bull call spread, $13, you bought the call and you sold another call at a higher strike for $5. So subsidized premium now is only $8. So with that, your profit will be achieved when the ST goes up by just $8. So at $78, you're already reaching a break-even point. But maximum profit is 22. Why? Because you're getting $22 profit because you've got another $5 gone into the by selling the strike of 100, right? Let me explain to you again. Okay, under the long call alone, that you have invested $13 as the call's premium, but of course, as a strike of 70, the price has to go up to 83. That is, to fully recover the premium, it has to go up to 83. And the profit is unlimited after that. But if you buy a bull call, there you are, that you have bought a call at 70 and you have sold another call at 100, right? So by paying $13 to your long call, and receiving $100 from your short call, your premium is subsidized to $8 only. So therefore, you will start making profit when your K1 goes up to by $8 to $78, you're already in the profit region. But however, there's an upside limit there, is capped there. Why? Because your short call will start being exercised once the ST reaches 100. So therefore, $100 minus 83 gives you $17. Plus $5 you have received as a premium for selling the short call. So 17 plus 5, the only profit you can make there where it will cap there, after that it will become flattened, is $22. So therefore, the maximum profit in the bull call is $22. Maximum profit in the just long call is unlimited, but you have to wait for if the price have got a large swing by $13 to recover and above, then yes. But if you want to protect the up potential, then of course between the 78, between the 83 and 100, you're making money. The 100 minus 83 is $17. That is your profit when you have a bull call. But above to that, you have received $5 as a premium from selling the short call. So $22. You understand now? Okay, what is the use of bull spreads? Bull spreads limit both the upside profit potential as well as the downside risk. It may be used when the investor may have a positive or bullish view about the future price of the underlying stock, but buying a call limits to the downside risk would be costly during bullish sentiment, because if you set it up for a K1, let's say $70 in the example earlier, if your call is going to be set at a strike price of $70, then you're going to pay about $13 premium. So your price has to go up by $13 before you can see any profit. But if you want to subsidize that premium by shorting a second call at a higher strike price, the investor will use the proceeds from the second call price, call options premium, to offset or to subsidize the first long call option premium. In return for this, the lower cost, they are prepared to reduce the upside gain potential, but of course, they'll be limited, as I told you, up to the $22.